All right, so in this video, we're going to talk about some properties and characteristics of insurance contracts. So the first one is indemnity. And the principle here is that the compensation the insurance company will pay is limited to the losses. So if you have a home worth $100,000 and you have a homeowner's insurance policy and it burns to the ground, they're not going to pay you over the $100,000 no matter what. And in fact, there's actually a good chance they're going to pay less than that. The reason for that is in certain cases, um, there are deductibles. And so that's the amount of insurance or the amount of the loss that you have to pay before the insurance company starts paying for things. And there are also limits. And this actually brings up the point that in my example, if the home is worth $100,000, that's for the sort of the structure itself in my example. If you have property within the home that is insured, then that adds some other things that they may actually compensate you for, but there are often limits to that. So for instance, they may only pay a maximum of, say, $1,500 for jewelry that was lost in the fire. So the idea there is that for indemnity, the amount of money that the insurance company will pay will be, first off, limited to the actual losses. So they will not pay more than you lost. So if your total lost value for your house burning down is $100,000 for the house and $20,000 for all the property in the house, under no circumstances are they paying more than $120,000. And the reality is, once you factor in the deductibles, the portion that you might have to pay, and limits on certain classes of property, so perhaps limits on jewelry, limits on artwork, limits on personal goods like clothing, things like that, then they may well pay less depending upon what you had in your home. The next characteristic that we need to look at for insurance contracts is subrogation clause. And this is a clause that basically gives the insurer a claim against a third party. So here's kind of how that would work. Let's suppose you are in a car accident, and let's say you're driving in a state where the fault of the driver matters, which is most states. And let's suppose that the other driver was at fault, which means that the other driver and his insurance policy needs to essentially pay for the damages caused to you and your vehicle. If that's the case, if you had certain types of insurance on your vehicle, your insurance company may actually be willing to pay, provided that you basically sign over and subrogate your claims and allow the insurer to go after the other insurance company. So basically, what's happening here is the other person and the other person's insurance company are on the hook for the damages that they caused. If you have kind of two choices, you can either go directly to that other insurance company and say, hey, you need to pay for the damages, or if you had certain policies on your car that would normally cover damages to your vehicle no matter what, then you go to your insurance company and you basically say, okay, please fix my car. And your insurance company is going to say, well, okay, we can do that, but you have to now give us the right to go after the other insurance company, because the other insurance company is supposed to be paying. And so if you allow your insurance company to pay for the damages that were caused by the other vehicle and driver, then your insurance company will need to have the right to claim against that other driver and insurance company to make that make them whole for paying to fix your vehicle. Also, an insurance contract needs to have an insurable interest. So in other words, there has to actually be a financial loss that's involved. And basically, this has to be a financial loss that you had an interest in. So for instance, I have to own the home that was insured, kind of a thing that when it's lost, right? Or let's say I'm looking at say a car insurance policy, and I own the car, and there's hail damage, right? So I actually have to have the financial loss. So the financial loss has to come to me. So where there's going to be an issue, for instance, would be I can't buy an insurance policy covering damages to my neighbor's house. because I don't have an insurable interest there. If a tree falls on my neighbor's house, that doesn't damage my property. That doesn't cause me a financial loss. So I don't have an insurable interest there. And basically, this is typically required at the beginning of the policy and at the time that the loss happens. So if I buy an insurance policy on a car and then I sell the car to somebody else and then they get in an accident, well, my insurance policy is not covering that other person's accident because basically at that point, the person who bought the policy, no longer have an insurable interest in that vehicle because I don't own the car. So if the car gets damaged, that doesn't financially damage me anymore. Now, there is sort of an exception to this, which is life insurance, which is not an indemnity policy. Okay, so indemnity, back to indemnity, that was the compensation is limited to losses. So for life insurance, we don't have that. What we have with life insurance is basically the idea that you buy a policy, you pay your premiums, and if you die within the insured period, they pay out the specified amount of money. And in that case, you don't really have like a property kind of a scenario where I have an insurable interest in like a proper piece of property or something. So you basically are not going to have that at the time of loss. Because at the time of loss, the person who bought the policy is dead for life insurance, right? So because that's the whole idea behind life insurance. You buy a policy, they pay out when you die. Well, when you die, you no longer have an insurable interest because you're dead. So they don't require that for life insurance. And it's just not an indemnity policy generally. Also, there's a requirement of utmost good faith. So this is basically related to the various representations by the buyer. So in other words, when you buy, say, a life insurance policy, you're making statements about what you do or don't do. You're making statements about what your occupation is. You're making statements about kind of what your health looks like. You're saying whether or not you smoke, for instance. And so from that standpoint, the requirement is utmost good faith in your representations as the buyer of the policy. So basically, you're acting in good faith. You're not lying about what you're doing. You're not hiding things like that. So also, you could have as a condition of the policy a warranty. So this could be a promise to do or not to do something. So for instance, if I buy a property insurance policy on a piece of property, there could be the requirement that or a promise, a warranty that I promise to have it sprayed for termites every year or something like that. So an insurance company could require some kind of behavior, and so you're gonna have to promise to do or not to do something. If you promise to do something and if you don't do it, then that could be a problem. Concealment, so hiding a material fact. So let's say if we're looking at health insurance, for instance, and let's say that you are a chain smoker and you're smoking a pack a day, cigarettes, but you say, I don't smoke. Well, that's concealment. You're hiding a material fact. That's very much relevant to the policy, and you're hiding it, and that's going to be a violation of the utmost good faith, and so that's going to cause serious problems and possibly just invalidate that health insurance. Adhesion is basically saying that the buyer can't negotiate the terms. It's adhesion. And then the reason for this is basically that policies have to reach a certain amount of regulatory approval or receive a certain amount of regulatory approval. So that means normally the policies are sort of packaged. And as a result of that, as the buyer of the policy, you can't negotiate the terms and basically just completely say, hey, I just want to completely change how this policy works. Now, that doesn't mean that you can't seek out different provisions. That doesn't necessarily mean that you can't seek out different types of policies from competing companies, et cetera. But what it does mean is that typically there is a certain set of terms associated with the policy. And when we're looking at this set of terms associated with the policy, you can't negotiate that criteria that's listed in there. Also, for insurance contracts, typically they are aleatory, and that means that uneven dollar amounts are exchanged. So let me give you an example with life insurance. So let's suppose you buy a term life insurance policy for 10 years. that's going to pay out $1 million if you die in that 10 years. You make your first payment today, the policy goes into effect. Next week, something happens and you die tragically. Well, if that's the case, let's say you die in a car accident, okay? They're going to pay out the full $1 million policy, and clearly you did not pay them the same amount, right? You didn't pay them $1 million. You paid them something a whole lot less. So typically with insurance, you are going to have uneven dollar amounts exchanged. You're going to pay a small amount up front. Possibly you never get anything back because the bad event never occurs. And little side note here, you should be happy about that. The idea behind insurance is it helps you sleep well at night. Okay, so for property insurance, life insurance, things like that, you are trying to protect from the financial losses that would occur due to a sort of a bad event. So really, you should be happy if the bad event never happens. All right, in which case you would just pay and pay and pay and never get anything back. But that's fine because this is protecting from the financial loss of something really bad occurring, right? So we don't want the bad thing to occur. But typically what will wind up happening with insurance is that it will be aleatory. There can be very uneven dollar amounts that are exchanged. It's hard to know who's going to wind up paying more. It depends on whether that insurance policy gets invoked or not. Basically, the insurance contracts are also unilateral, and that means there's one promise to pay if the covered event occurs. So basically, there's a promise in there that the insurance company pays if the covered event occurs. Also, there can be conditions that are specified in the insurance contracts. So they can be conditional, and that means that the buyer must abide by the policy requirements. So sometimes it could require inspections for termites, or it could require that you continue to not smoke, or who knows what. Okay, so if there are conditions associated with the policy, then the buyer has to abide by those. Also, insurance contracts are personal, so the policy cannot be sold, etc. So if you buy a life insurance policy that's protecting your life, you can't sell it to somebody else. If you think about that for life insurance in particular, that starts to make a whole lot of sense, because that would create some serious conflicts of interest potentially if you could just sell your policy to somebody else. Then if it's a life insurance policy, then they would suddenly have a vested interest in you dying. So that would be kind of a problem. Also, it's possible that an insurer can waive a requirement. So there can be a waiver in an insurance contract. So normally an insurance contract may require that some condition be met or something occur, and the insurer can waive that requirement. And in some cases, if the insurer does not sort of follow up on requiring that something occur, there's a chance that it may be considered sort of waived by default by the insurer. So sometimes that can occur as well. The last characteristic we're going to talk about for this for insurance contracts at the moment is estoppel. Kind of a fun word, estoppel. And this is basically indicating that the insured person or entity cannot be denied if you relied upon the information that was provided. So if you are working with an insurance agent, the insurance agent says, yes, you can buy this policy for your home, and basically it doesn't matter. Let's say it's life insurance. This person can buy a life insurance policy, and it doesn't matter when you die, the full amount pays out. It doesn't matter how you die, the full amount pays out. And if you rely upon that information, even if that's essentially perhaps slightly contrary to the policy, then basically the insured can't be denied. So if you were told this is how the policy is going to work, and you relied on that, then basically that can't be denied. Now, the practical issue with that would be, how do you prove what, say, the insurance agent told you that was contrary to what the policy says, right? That might be difficult to prove. But if you can prove that the insurance agent said this policy covers this, and even if that's not in the fine print, but the agent said it covers this, then basically the insured can't be denied the claim based on that. Okay, So those are characteristics of insurance contracts that we'll talk for today. And thank you for watching, and have a great day.